Hi, I'm Andreas Steno, and welcome to the Real Vision Daily Briefing. We are sending to you live Wednesday, September 7th, on the back of an interesting day, in particular in commodity markets. We've seen a landslide in the oil price over the past couple of hours here. And today we're actually going to ask the question whether the world is upside down. What will central banks do in response to all of the bailouts that we've seen announced in Europe this week? And to answer that question, together with me, I've invited Darius Dale, the founder of 42 Macro. Darius, it's great to see you again.
Likewise, Andreas. Good to see you, man. How you doing?
All good. Darius, let's have a look at the price action today. We've seen a material drop in the oil price over the past 3, 4 hours here. What do you make of the price action in commodity space right now?
Yeah, so I'd start by saying, great question, because that to me seems to be what's driving the risk across broader asset markets in terms of the positive response we're seeing in fixed income, and as a function of that, a positive response we're seeing in equities and credit. This move in oil is largely technical from my perspective. Just at least in terms of you had this sort of I forget what they call the death cross or whatever. One of these, I guess, when the 50-day moving average breaks down below the 200-day moving average, you've seen a lot of investors de-risk their exposure in terms of taking down the position size or just getting rid of the exposure altogether. In fact, it was something we flagged last week. WTI crude oil specifically broke down to bearish from the perspective of our volatility adjusted momentum signal. Typically, what happens in these big breakdowns or breakouts, volatility tends to be the leading indicator for price. And so this is another example of the volatility signal, kind of front running what is very clearly kind of a technically driven sell-off. Is it sustainable? I mean, we've seen OPEC Plus come out and try to sort of push back against it in terms of trying to stabilize markets. We saw a pretty token supply production targeted production cut a couple days ago. Clearly, it did not work, and so I think we're kind of in a phase over the next couple of weeks to see their response. Is $80 the right price from their perspective, or do they want it more close to 90, which is kind of where they initially started targeting some intervention, verbal intervention.
So we've seen basically politicians across the European continent trying to contain the situation within the electricity and energy sector over the past 4 to 5 days with announcements on bailouts. We know that the European Commission will meet up on Friday to discuss the situation and potentially solve it, hopefully solve it, I'd say. But what do you make of the current sort of string of announcement on bailouts in Europe? Is it something that matters for markets?
Yeah, definitely. So let's play this forward, right? So typically, what happens when you have expansionary fiscal policy, you tend to wind up with higher levels of demand, both for the private sector, and as a function of that higher level of demand, you wind up with exacerbating supply chains, et cetera, and you wind up with higher inflation. This type of intervention, however, from a fiscal authority perspective, particularly in Europe, we got the new Prime Minister Liz Truss plan to curtail energy prices. There's talks at the European Council to do the same thing. If we start to see that, then what we're going to see, we're going to wind up with, kind of a depressing influence over inflation, right? Because we have not seen the full brunt of electricity price hikes get pushed to European consumers either in the UK or across the broader European Union. So at the margin, that would be a positive development because traditionally what happens, right? The fiscal authority eases and has expansionary policy, whereas the monetary authority in these types of regimes tends to have contractionary policy to mop up some of the excess liquidity. And I think on the margin, you could wind up in a scenario relative to current market pricing where both the fiscal authority and the monetary authority are easing at the margin because, again, we're addressing the energy price shock directly.
If we look at the current policy mix, so bailouts being announced and presented by right about every prime minister in Europe right now, and interest rate hikes being on the table from the European Central Bank, from the Bank of England, from Bank of Canada, just again today from the Federal Reserve. It seems as if the world is sort of upside down compared to the 2010s, doesn't it? I mean, it seems as if the central banks are now the tight part of the policy mix, while the politicians are bailouting everyone.
Percent. I mean, with plenty of other guests on this program and other programs on Real Vision have come on and talked about this. We have transitioned to an era of fiscal dominance in lieu of monetary dominance. Now, what's driving that transition at the ground root, at the first principles level, is a proliferation of sort of, kind of a decline in working age population participation in the labor force, largely because we shipped, a lot of the developed markets have shipped their jobs to lower cost manufacturing hubs like China, Mexico, et cetera. And then you've also seen a blowout of income inequality, not the least of which is being driven by the expansionary monetary policy we saw throughout the 2010s. And so, as a function of that, we've seen in the pandemic. The pandemic was very clearly a big lurch forward in this process for expansionary fiscal policy. But I would argue, at least in the U.S. in particular, it started with the Tax Cuts and Jobs Act, 5 years ago. And so we now are in this new era where central banks are no longer sort of, the kind of the only game in town. If anything, they have to take out their mop and mop up the excess liquidity. But again, I don't know that the desire to mop up the excess liquidity will continue to rise at the same pace if, in fact, we do see fiscal authorities kind of take to kind of address the energy crisis head on.
The European Central Bank will meet tomorrow, and I think the consensus is slowly but surely moving towards 75 basis points among sell-side analysts. The market is a bit less certain on the 75 basis points, but given this backdrop of massive bailouts being presented across the European continent, what do you make of the European Central Bank's reaction function in relation to this series of bailouts being presented?
Well, so to me, I think it's less about in my opinion, I think it's less about the central bank's reaction function and more about the market's reaction function. Because this expansion of fiscal budget deficits effectively, which is what this is going to equate to, has to get capitalized by someone or some entity. So used to the ECB expanding its balance sheet, the Fed expanding its balance sheet, and effectively capitalizing, the European governments and the U.S. governments as a function of that process. But now we're very clearly in a state where, at least on the U.S. side, balance sheet is contracting. On the European side, balance sheet is probably, kind of stable, if you will, over the next, at least the current outlook is probably for stability. And so it's pushing more of the onus in terms of capitalizing the governments back towards the private sector. Now, that's not the end of the world if you're talking about Europe because it's a current account, so at least for now, very
Mm.
current account surplus nation with excess savings on its balance sheet. The U.S., however, on the other hand, is a current account deficit nation. Again, narrowly, we've seen that spread narrow in terms of trade shock. But we need to capitalize the fiscal authority to the extent we do see an incremental lurch forward in fiscal policy in the U.S., which we are experiencing. We talked about that over the last few weeks. We see the student loan debt relief. We're seeing things like caps on gas prices, et cetera. There was one more thing, but yeah, there's three things the Biden administration has done, inclusive of the Inflation Reduction Act, to sort of basically take up incremental fiscal spending to effectively offset inflation, which historically is not the smartest idea.
True. But we've actually seen markets calming down a little bit after the announcements of the bailout packages in Europe. And I want to bring up a chart on the so-called clean spark spread. And now I'm getting thrown into the deep end here because I'm not an electricity expert, but I've spent most of my week in telcos with power trading desks in Europe because electricity is basically what's driving everything right now in the European landscape. And what this measures is basically the input spread between the natural gas price and the electricity price that a utility can sell forward on. And the interesting thing here is that the spread between the electricity price in forward terms and the input price of the natural gas used to create the electricity basically blew up throughout last week, and it went all the way above 400 euros per megawatt hour, which is a level that we've never seen before. And this was the exact spread that triggered this story about 1.5 trillion worth of margin calls across the European continent in the energy sector. So we've actually seen a sharp retracement in this spread after the government stepped in to sort of calm down markets with these bailout announcements. So I think we can sort of take that margin call story at least partly off the table again. It's still bad, but it's not as bad as it was reported last week. So quite interesting that we see these developments in the European electricity markets. But I also wanted to ask you, Darius, is the electricity market a hot topic in the US as well right now?
No, I mean we still had a hot electricity. I do have one thing to add, and at the expense of sounding like a complete uninformed fool on this subject matter. I thought when I saw the story on the 1.5 trillion in margin calls, that was actually positive. It's like the only time where margin calls are broadly positive, because what it probably ultimately means is that a lot of traders and speculators who've driven up the price of forward gas prices in Europe have to basically close those positions
Yeah.
out those positions. And I think that's, one of the outcrops of that is that, it's getting too expensive from a risk budgeting perspective to maintain the position sizes. So we've seen those positions cut, and as a function of that, the outlook for European energy prices at the margins relative to that relative to that condition is actually improved. This is something, we're not this specific thing, but we're picking all these different dynamics up in our nowcast models for things like Eurozone CPI. In fact, Brian, I'll just pull up that chart. Our model is suggesting that European inflation is likely to peak sometime in September and October timeframe. And that's, relative to sort of the worst case scenario, which is we continue to see ongoing price appreciation in energy and electricity prices, which would have been picked up by our nowcast model. That's the purple line in the charts. That's a better dynamic than I think the consensus view on Europe. And you talk about this all the time. The consensus view on Europe was that inflation is going to just go through the roof. Europe's going to go through the abyss economically. And I think over the last few weeks, we've gotten enough data points from the perspective of policy and the perspective of price in the markets to tell you that those things are less true.
I tend to agree with your assessment, by the way. I think we will have a material spike in the CPI index in Europe over the next 1 to 2 months before a sharp retracement low. And that's sort of also what's being indicated by the future pricing right now in natural gas space, for example. I also find it interesting that given that Putin actually decided to cut the flows to zero in the Nord Stream 1 pipeline, we haven't seen new highs in the European nat gas futures, which is interesting because if the flow is already zero, it's kind of impossible to surprise to the downside on the flow, right? So I think the worst case scenario is more or less priced in by now.
Or sell the news. I mean, exactly. Yeah. Who's buying European nat gas today on the view that Putin might cut off the supplies? The positions were already put on. So that's, one of these classic dynamics where markets are forward looking, and very clearly they priced in already the furthest left tail of the distribution of outcomes. And I would argue at the margins, we're probably cutting off that tail just based on the policy response.
If we look at the European Central Bank ahead of tomorrow, I think we can bring up a chart on the pricing of the European Central Bank over the coming couple of years here. The Euribor curve peaks just south of 2.5%. What do you make of a level of 2.5% on the policy rate in sort of comparison to inflation levels close to 10% or even above?
Yeah, so there's a couple things I'll say. Obviously, relative to history, that's usually not going to cut it, historically speaking. When you analyze tightening cycles, you tend to have to get the policy rate above the observed level of inflation, in order for it to see that big disinflationary process take hold and have it be self-sustaining. This time might be a little different, though. Famous, last words are, most dangerous words. But if Brian, if you pull up that chart, slide 98, where we show the ISM manufacturing and services indices, there's a sub index within those reports called the percentage of respondents reporting slower supplier delivery times. And this is a good proxy for supply chain disruption. So when the chart spikes, that's telling you a very high and large percent of respondents are saying, hey, it's harder to get goods, harder to get services because there's supply chain disruptions. Well, we basically seen the opposite take place in the most recent months. For all the talk of supply chain disruptions that we had throughout 2021 and into the early part of this year, they're basically moving in the opposite direction with the same degree of expediency that they moved to the upside. And so there is some element of inflation that we all understand, or at least most of us should understand by now, that was in fact transitory. And that transitory inflation is receding at the margins and may make, this sort of European inflation story and even the US inflation story look a lot better in the coming months than I think, probably the most ardent bears are willing to admit.
If we look at the FX developments over the past 3 to 4 months, it's quite clear that the release valve, when we have a situation with an energy crisis in Europe and in Japan, and central banks sort of hesitant to react to it via tighter policy, is sort of the FX channel versus the dollar. We've seen new lows during the day in the pound sterling versus the dollar. I think we need to go back, is it 3.5 decades to find as low levels in the cable, so this pound sterling versus the dollar. What do you make of the FX development right now and the spillovers to central bank reaction functions in Europe and in the US?
So, I mean, very clearly, what's driving the sort of the currency market right now, it's much bigger than the traditional sort of interest rate differential story. That's kind of I would argue, like the base case scenario. Right now, what's driving the FX channel largely is this sort of terms of trade shock we're seeing between the U.S. and Europe. I mean, Europe is swinging from, largely, if you look at the Eurozone continent in aggregate, a very large current account surplus a country to, or not country, region or geography or economy rather.
Mm.
And that looks a lot closer to more neutral. And on the other side of that reduction, that narrowing of the current account surplus, we're having ours, sort of our current account deficit narrow. And that's really what's driving those flows. That terms of trade shock is really showing up in flows. It's also showing up in the capital count as well. Don't forget that the U.S., if you aggregate the last few years, we're tracking it like plus 7-8 trillion dollars in terms of the change in our net international investment positioning to the downside, which means we're importing all that capital into the U.S. And obviously, there's been a variety of reasons for why that's happened throughout the pandemic era, not the least of which is, we issued a lot more debt than most people. Because of the issuance of debt, we had a massive fiscal expansion that turned into a massive outperformance in growth, massive outperformance in, earnings growth, corporate profits, and ultimately massive outperformance in asset markets. And so, all that capital, is kind of, I would argue, just in terms of the relative performance of indices and the relative valuations of indices is still, sort of trapped here. But obviously, if you look forward ahead, maybe 6-9 months from now, that dynamics are likely to reverse once we get towards the lows of the global growth cycle and we start to see some of those flows, abate and go in the other direction.
In relation to this debate on debt levels in Europe, I wanted to play a soundbite for you. It's from an interview I did with Emil Kalinowski, so the host of the Eurodollar University podcast, by the way, a very good podcast. He's talking about the sort of fundamental risks underlying the situation in Europe, because Europe basically headed into this energy crisis with very high levels of debt, both privately and public debt. So let's listen to Emil's point here and get back to that debate.
As Jeff and I often talk about on the show, we're not fans of central bank quantitative easing in terms of generating economic activity or inflation. We don't believe it creates either. We believe that they create bank reserves that then sit idle on bank balance sheets because the banks think that it is too risky to lend out there. And right now it does seem absolutely too risky to do so. That's why I believe it would take politicians strong-arming these banks, commandeering them, informing them that they must, as a national security issue, as an emergency to the cost of living issue, that they must issue the credit and the loans into the private sector. And that's what will get liquidity into the system. Quantitative easing isn't really liquidity for the economy. It's liquidity for the banking system that doesn't want anymore. Mm. If you want liquidity for the economy, you've got to get banks to lend. They won't because it's too risky. The politicians have to step in and guarantee the lending.
The entire interview between Emil Kalinowski and me will be available today for subscribers on the Real Vision platform. But back to you, Darius. Emil's point is obviously that Europe entered this energy crisis with a massive private debt load already, and that to ensure that banks will keep lending to the economy get through this crisis, the politicians will likely have to underpin the banks by guaranteeing parts of this debt load. What do you make of his point that banks actually make the true channel of liquidity to the real economy and central banks don't?
So that is correct. That's accurate. And by the way, I'm a big fan of Emil and obviously Jeff Snyder that work with Eurodollar University. The two of them can certainly forget more about kind of shadow banking and all these dynamics, on the way to the bathroom that I'd ever learn. But the one that I will push back and sort of on kind of one of his key takeaways, which is, like QE doesn't do anything, it doesn't create liquidity. It actually does if you think about it through the sort of portfolio channel effect, right? When we do quantitative easing, we're taking debt securities out of the private market and leaving investors with the end investors with cash. And so in order to, that cash, if investors don't want to sit there in cash because rates are zero, usually when the Fed's doing QE or negative, for instance, for the ECB, then investors wind up taking more duration risk. They wind up taking more credit risk. Or if you think about it in terms of private equity or venture capital, they wind up taking more liquidity risk. And so it does, through the shadow banking sector, create liquidity for the real economy. It's just not being observed on bank balance sheets, which is one of the reasons why, if you look at the share of total private non-financial sector debt on bank balance sheet in the US and Europe in particular, we're at multi-decade lows in the US around 32% and around, I think somewhere around like 54% in Europe. The growth of the shadow banking sector has certainly been one of the offshoots of this quantitative easing era.
I asked Emil the question whether it's possible to find a region in the world with low private debt loads, if you sort of fear the scenario of too high debt loads privately held. Do you have an answer to that? Because it's quite tricky to find a good region in the sense of finding a region with a very low debt load.
This is something I've studied extensively throughout my career. High and low doesn't necessarily tell you much from a predictive standpoint. It's the change in the debt, the speed of the change, rather. So one thing we look at is the credit gap metric, which is the change in the private non-financial sector credit to GDP ratio on a 5-year or a 3-year Z-score basis. 5-year for certain economies works better, 3-year for other economies that are more cyclical. Whenever you get to a scenario where that metric is somewhere close to a 2 sigma event, typically what happens is you tend to enter a deleveraging cycle on the other side of that. It doesn't have to happen overnight, but if you look forward 12, 18 months from 2 sigma threshold in that statistic, you tend to wind up in a deleveraging cycle, potentially a recession, usually a recession. We're not there yet in terms of US private non-financial sector debt, namely because the household sector balance sheet has really not grown in terms of the total amount of leverage as a share of GDP or share of income in recent years. Corporate sector balance sheet has really grown, but generally speaking, one of the reasons the corporate sector balance sheet has grown from a leverage perspective, at least here in the US, I'm speaking to the US specifically, is because corporates took advantage of very low interest rates in 2020 and basically issued a crap ton of debt at historic lows and historic durations. And so I'm not so sure that the kind of the threshold that's currently being breached on the corporate sector is as draconian as it might otherwise imply. Europe's a little bit less. Certainly, I don't know the composition of Europe off the top of my head, but I do know that from an aggregate perspective, we're still not breaching those kinds of levels in Europe either. So I would argue that just in terms of like needing to see a deleveraging cycle born out of all this tightening, that's not necessarily the modal outcome. The modal outcome, however, is we should likely continue to slow, and I think that's pretty clear across a lot of the economic statistics.
If we look at a live assessment of the global economy, you've brought a chart with you on the manufacturing PMIs and the service PMIs across the globe. So why don't you speak to the point of the slowdown that we see in various PMI measures across the globe?
Yeah, absolutely. I mean, it's pretty clear that if the U.S. is continuing to outperform economically, both in manufacturing and services. The one thing I call out is that it's very clear that Europe is significantly underperforming, and so it tells you that the sort of the R star, like the neutral interest rate, or because again the markets are pricing in the policy tightening, and so it's about it's more about how money markets price in, bond markets price in these dynamics, credit markets in terms of credit spreads have priced in these dynamics, and we're already seeing that way on European growth. At the same time, we're having obviously energy-driven terms of trade shock and a reduction in output born out of just too high electricity prices. That should continue. We're going to continue to see growth slow in Europe. I have no clue on China given the context of zero COVID. I think if you remove zero COVID, China, I wouldn't necessarily say the Chinese economy is a ball underwater because we have not seen the kind of easing cycle that we traditionally have seen, either monetary or fiscal, in order to sort of really create a sustained bout of reflation in the Chinese economy. But at the margin, we have eased a considerable amount in recent quarters. If you look at the decline in 3 month Shibor over the last kind of 6 to 9 months, if you look at the decline in the Chinese yuan, particularly over the last 2 months, now that's kind of starting to reverse, particularly because the Chinese yuan is actually getting to this sort of, I don't want to say imaginary, but this kind of all important 7 threshold in terms of the USD CNY rate. And so as a function of that, the Chinese authorities, the PBOC, is really sort of guiding the reference rate on the FX to be much stronger than what the market is expecting, because I think they're trying to defend and put a floor on the currency.
Yeah, good point, Darius. I mean, we talk a lot about the U.S. economy, the Federal Reserve, and currently also about the European economy as a consequence of the energy crisis. But we tend to forget to talk about the development in emerging markets. So when you look at the PMIs across the emerging market space, what's the signal being sent by the emerging market economies right now?
So don't forget that a lot of the EM economy, so it's better than you would expect, just given the strength in the dollar and the Fed's policy tightening regime. Part of the reason I myself personally have been largely ignoring emerging markets, because history shows when the Fed is in a tightening cycle and the global growth cycle is pointing downward, EM tends to just be a higher beta way to lose money. Generally speaking, it's like, just, if you, at best, those are short ideas. At worst, just do nothing and wait for sunnier days ahead. So I think that's still the story with EM, largely until we get to until the market is ready to truly price in an inflection in the dollar liquidity cycle, which itself will be born out of the Fed or investors receiving clear and confirming evidence that inflation is getting under control, which may come as soon as next Tuesday, by the way, or certainly by we'll have a pretty clear indication on that on October 13th when we get the September CPI report. The markets may be ready to start to price that in, or it may be the case that the markets are going to have to deal with this current policy mix, which I think is still the modal outcome. Not the modal outcome. I still think the base case scenario, at least from a dollar liquidity standpoint, is Fed gets the target, the Fed funds rate to 375 or 4, sits on that for all of next year. We do the entire brunt of quantitative tightening. That sounds extremely negative when you say all those things back to back to back. But one thing I would argue is that if 375 or 4 is not as restrictive in this sort of new highly capitalized economy from a dollar liquidity standpoint, if that's not nearly that restrictive, then we're probably not going to go into recession. If we don't go into recession, then investors are going to feel comfortable taking more risk, either duration or credit risk. And so you could see a pretty significant drain in the reverse repo facility balance to offset that quantitative tightening. So it's a tricky road ahead, man. It's a few months, like a month ago, I said, this is back the last time we were crossing 4,000 to the upside. I said, when I made that comment, I said, look, we could be at 4,000 by year end 2023. Like in that scenario, and have chopped everyone up to shreds between now and then. Because again, I don't necessarily at this particular juncture see very clear runway to the upside or very clear runway to the downside. Although again, based on next Tuesday's inflation report, and certainly by the September report we're going to get on October 13th, I will have a much.
We have time for a couple of questions from the audience, Darius. We've got a question from Pierce on YouTube, and he's asking us whether it should be seen as a positive or a negative for the local markets in Europe and in the UK that we see these big bailouts being announced. So is it a positive or a negative for the local currency when we see bailouts of plus 5% of the GDP? Good question.
Bailouts are positive. That's the history shows that from asset market perspective. You tend to like markets love bailouts. What those programs effectively equate to is a positive shock to growth channeled through a negative shock to inflation. Certainly relative to the expectations out there. So that they are positive. I mean, I wouldn't fight the fiscal authority. They're effectively nationalizing the cost of energy in Europe. That's a positive development if you think about it from the perspective of the economic output and also the perspective of asset markets. So the one thing I will say that's negative on the other side of that is who's financing this stuff. China and Russia don't want our paper anymore, so we, the private sector, have to capitalize this, and we, the private sector, demand higher interest rates in order to take down these incremental moves higher in budget deficits. So that's partially what's probably driving rates higher across the board, because the whole world is starting to wake up to the world where fiscal authorities are comfortable financing a lot of this stuff.
We have a question from Bo. He's asking you, in a global energy crisis where few of the supply transport issues with crude have been resolved, what does a 33% drop in the price of crude over a 3-month period say to you, Darius?
It's very positive. So I mean, I just did the math on this before the show. So if you just look at the U.S., let's also start with the U.S. So if the gasoline prices, because that's what matters to CPI, gasoline prices are down. If you look at it on a monthly average basis, down 13% in August versus only being down 8% in July, right? So like we have a bigger decline in gas prices in August than we observed in July. And don't forget, in the month of July, we had 0% inflation, according to our president, which was technically true if you look on a month-over-month basis. So it's obviously positive, certainly in the context of investor positioning on the buy side being quite light, and the kind of general consensus narrative, being that inflation is a problem and it's going to remain a problem for a long period of time. If we continue to see these developments from an energy market perspective, and those developments further proliferate through the, through the more core inflationary channels, we're going to be having a very different conversation about asset markets, in a couple of months from now. So I think I put that on everybody's radar.
I've made it my trademark to always conclude the daily briefing with a meme, Darius. And I think we need a meme on the global central bank situation today. So, I mean, right about every central bank is hiking interest rates. The ECB will hike interest rates by either 50 or 75 basis points tomorrow. But the cat, or rather the dove left, is still Bank of Japan. We're doing yield curve control. Who cares, right? Everybody else is hiking interest rates. So ultimately here, what do you make of Bank of Japan in this setting?
Look, they I don't know. Kuroda is he playing chess? Playing chess, right? In fact, Brian, I got the chart of Japanese CPI. So, one thing we do, consistent with our forecasting process, we're forecasting growth, forecasting inflation, in order to figure out what grid regime, the sequence of grid regimes that different economies are going to be in. And, he's gotten his inflation, if you term looking at, going past the 2% target. But if you look at our forecast, Japanese inflation is likely to peak kind of in mid to late Q4 and really roll over pretty sharply from there. And so, it's, if under that scenario, if you're talking about, would it have been a smart decision for Governor Kuroda to pull back on sort of yield curve control, at any point in time this year, asking that question 12, 18 months from now, the answer would have been no, because we were basically just going to round trip on inflation, by the end of next year. So probably playing chess relative to we're banging our heads on the table every day, trying to squeak out a few basis points of return, while we are playing checkers. But it is what it is. I mean, this policy divergence is quite historic. I mean, I don't know what there's no cap to the dollar, right? Like if you think about term shock, yield curve control in Japan, Fed remaining tight, at least for now in terms of the inflation dynamics. Where's the dollar? Where's the peak of the dollar? I mean, you got Melkman on your podcast. This recent episode, excellent episode, as they tend to always be. I think him and I see very similarly. We have a very similar framework in terms of thinking about currency risk. And I definitely agree with the dollar bear case next year. But how in the hell do you stop this dollar bull market today over and I think that's going to be something that's hard for markets to push back against.
Yeah. And honestly, right now, it feels like peeing against the wind if you go against the dollar trend, right? So I tried to dip my toes into a long euro versus dollar trade a few weeks back, didn't succeed. So I guess we're back to just trading the long dollar story for now, at least until this energy crisis is resolved. Darius, it was once again a great pleasure to host you at the Real Vision Daily Briefing. Thanks for joining.
Always a pleasure, my friend. Catch you next week.
Yeah, catch you next week. And to the audience out there, thank you for watching again today. We will be back tomorrow with all of the action surrounding the meeting in the European Central Bank. So I'll be joined by Jared Dillian tomorrow afternoon. So see you tomorrow.